How much home can you afford using a minimal down payment like an FHA loan, only putting 3.5% down if you have a salary and you make somewhere between $50,000 and $75,000 per year? Well, that's exactly what we're going to dive into in today's video. Now, this video isn't to tell you that's how much you can actually afford. It's a video showing you how a lender is going to calculate based off your income and your debts the number that you're actually pre-approved up to. It's up to you to figure out whether or not you can actually afford that payment. So with that said, we're going to do some income calculations. We're going to calculate mortgage payments based off a couple of different purchase prices using today's interest rates. Now, something to understand, interest rates change every single day on every single type of loan program, depending on what happens with mortgage-backed securities, as well as the overall market. So just because I'm giving you an interest rate here doesn't necessarily mean that's going to be your interest rate. In fact, interest rates are actually affected by more than 40 different factors. So understand in this video, we're using calculations based off having good credit, right? Not perfect credit, good credit, somewhere above, say, 700, 720, and we're going to be talking about FHA loans. Now, the reason we're talking about FHA loans is because FHA loans are typically the most flexible loans when it comes to qualifying for a home, especially when we're using a minimal down payment like 3.5%. Yes, conventional will allow you to put only 3% down, but to be completely honest, the payment is likely going to be less on an FHA loan than it is on a conventional loan with that minimal down payment. So we're going to be talking about FHA because not only is it lenient with regards to credit, it's also the most lenient when it comes to debt to income ratio because it allows you to qualify for more home with more debt. That's because conventional only allows you to have a max debt to income ratio, if you're kind of a perfect candidate, if you will, of around 50%, whereas FHA will allow you to go to 57%. Now, if you're watching this going, I don't even know what debt to income ratio is, what does that actually mean? Well, one of the things the lender is going to do when qualifying you to buy a home is they're going to look at your gross monthly income. That is your income before any taxes are taken out. Now, if you're a W-2 employee, you're an hourly employee, basically you can take that W-2 that you receive at the end of the year, your W-4 form, and you can divide it by 12 to get your gross monthly income. Now, it is an average over a 2-year period of time, which is a conversation for another day, but essentially what they do is they take that gross monthly income. So in the case that you make $50,000 per year, they take that number and they divide it by 12, and that's because there's 12 months in the year, which gives you a gross monthly income of $4,167. Now, I know a lot of people watch this video and go, Jeb, why are they using that number? Because I actually pay taxes. I pay money into my 401k. I don't actually take home that number. Well, that's the main reason, because people pay different amount of taxes based off their exemptions, based off where they're putting money, based off garnishments in some cases, which means everybody takes home a little bit different. So what they like to do is take the gross monthly income and use that number. Now, it's up to you to have a budget and understand how much you can afford. That's why I started the video by saying, hey, I can't tell you how much you can actually afford. I can only show you how the lender is going to calculate this. So in the case that you make $50,000 per year, that means they're using a number of $4,167. Now, when it comes to being self-employed, it's a little bit different because self-employed borrowers have different write-offs, and just because they make $50,000 a year doesn't mean they necessarily report $50,000 per year, and that can be a problem. And so that's why if you're at home trying to do these calculations, use this as more of a novelty type video, an educational video to get some basic calculations. Don't do the numbers here and run with it and not get pre-approved and try to buy a home. You need to go through the process. You need to talk to a professional, someone that can analyze your tax returns, analyze your credit report, and tell you exactly how much home you can afford to purchase. But in the case that you make $75,000 per year, that was our other number that we were using. We were using $50,000 and $75,000. So they take $75,000, they divide that by 12, which gives you a gross monthly income of $6,250. So we know our gross monthly income at $50,000 is $4,167. We know what it is at $75,000, that's $6,250. If you're somewhere in between that, if you make somewhere between 50 and 75, you can do a basic calculation and figure out your income from there. Now, as part of this process, not only is the lender looking at your income, they're also looking at your monthly debts. They're looking at whatever debts show up on your credit report. Now, things that don't show up on your credit report, things like childcare, things like your grocery bill, your gas bill, those aren't calculated into your debt to income ratio. They're only taking things that report on that credit report, things like your car payments, credit card payments, student loan payments. So any sort of revolving debt, any sort of installment debt that shows up on that credit report, they're going to factor into your debt to income ratio. So your debt to income ratio is made up of a front end ratio and a back end ratio. The front end ratio is just your housing expenses, your proposed housing expenses, the new house that you're trying to purchase. And what goes into that is the principal, interest, taxes, and insurance, along with the property taxes, any homeowner's insurance you have to have on that property. And if you're in a property that has an HOA, the HOA is also factored into that. So it's your total housing expenses is the front end ratio. The back end ratio, which is really where FHA is the most flexible and allows you to go to a 57%, well, that takes all the housing expenses on the front, and then they add that monthly debt that shows up on your credit report, and then that number makes up your back end ratio, which can't exceed 57%. But it's important to note that even though FHA allows you to go to a 57% on the back end, they have a cutoff on the front end ratio as well. You can't have more than 47% of your gross monthly income going towards housing expenses. Now, in the case that you don't have any debt, then your front end ratio and your back end ratio are essentially going to be the same, which means if you didn't have any debt, then you're going to have a 47% front end ratio and a back end ratio of 47%. But in the case that you have some debt, then your front end ratio is going to be maxed at 47%. And then once you add those debts in there, it can exceed 57%. Now we'll do some basic calculations in here to help you understand what that means. Now, one of the things that comes up with FHA all the time is that FHA loans are just for first-time home buyers. That's not true. You could have had an FHA loan in the past and get a new FHA loan. In fact, you can have an FHA loan now and also get another FHA loan, assuming you meet the qualifications to do so. Now, in the case that you're buying units with FHA, not only are they going to use your income that you're making, they're also going to allow you to use 75% of the units that you're purchasing income in order to help you qualify. So that income is going to be combined with your income, and then all of the calculations that we talked about today essentially are the same. Now, we're not going to get into that in this video. We're primarily today talking about the purchase of a single family residence, the purchase of a condo, if that's what you're looking at, using an FHA loan, which is 3.5%. And we're also using the salaries that we talked about in today's videos at $50,000 and $75,000. But in order to keep this video somewhat timely and not a long, extensive video, I'm just going to do some basic calculations. We're going to run over some numbers at both of those salaries to see what you would qualify for today based off today's interest rates. Now, before we do that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. And also, if you support the work and want to stay updated on everything mortgage and real estate related, do me a favor and subscribe to the channel. Now, earlier in the video, we broke down our gross monthly income. Now, I just want to take a minute here and talk about front end ratio and back end ratio. Because FHA has that max 47% front end ratio, we know that your housing expenses cannot exceed 47% of your gross monthly income. So in the case that you make $50,000 per year and they're using a calculation of $4,167, we know that your front end ratio cannot exceed $1,958 on your housing expenses. Now, your back end ratio can be as high as $2,375, which means in the example that we're going to use today, you can make $50,000 per year, have around $417 of monthly debt showing up on your credit report, and these numbers actually apply to what we're talking about. Now, as I mentioned earlier, don't use these numbers and run with it. Talk to a mortgage professional, have them look at your situation, run all the numbers, and confirm that the numbers are accurate. There's so many nuances in the mortgage process that can keep you from qualifying, or they may be able to add some more income back to your income and help you qualify for more. So it's super important to make sure you're working with a professional. If you don't have one, don't know where to start, I've created a list of people that I know, like, and trust to guide you through that process. So if you need a referral, there's a link in the description below. Now, when it comes to the $75,000 salary, you're bringing home $6,250. Well, 47% of that number, your max housing expense ratio, is going to be $2,938. Whereas your back end ratio is going to allow you to go to $3,568. In this case, your housing expenses can't exceed $2,938, but you can have somewhere around $625 or so in monthly debt. and you might still be able to qualify for this loan. Now, understand when you're going to that max debt to income ratio of 57%, not everybody is going to get that ratio, right? You need to have higher credit scores. You need to have compensating factors, maybe some additional money in the bank. You can't be the borrower meeting the minimum qualifications of FHA loans, which allows a 3.5% down payment with as low as a 580 credit score. If you're that borrower, you're not going to be able to likely get the 57% max debt to income ratio, which means you're likely going to qualify for less. All the more reason to make sure you're working with a professional when you're going through that pre-approval process, just so they can run the numbers and make sure that the information you're getting is accurate. But in the case that we say, can you qualify for a $350,000 home with a $50,000 salary? Let's take a minute here and break down what those numbers look like. Now, when you're buying a $350,000 home, something to understand with FHA is they only require that 3.5% down payment, which in this case is $10,500, which means you would have a loan amount of $289,500. But something to understand about FHA loans is they have something called upfront mortgage insurance. You can't avoid this. Every single FHA borrower, regardless of their credit score, regardless of how much money they're putting down, has upfront mortgage insurance. Now, you can choose to pay for it outside of escrow if you want, or you can finance it into the loan amount. Most people just finance it into the loan amount because it only adds a little bit more to their monthly payment versus coming up with that money out of pocket. But with that said, it's 1.75% of that loan amount. So in this case of $289,500, if you multiply that by 1.75%, that gives you $5,066. Well, once you add that back to the $289,500, your base loan amount is $294,566. Well, in the case that we're using interest rates today at 6%, which is essentially where they are on FHA, now you might be able to go out and find a lender that can get them at 5.75, or you might be talking to a lender that's at 6.25. Understand there's somewhere in that range, but also understand this year interest rates are likely going to continue to go down. So if we're talking about 6% interest rates today, as interest rates come down, you're likely going to be able to qualify for more home, which means housing affordability is going to improve a little bit. So if you can qualify for the numbers based on today, or maybe you're a little bit short, well, as interest rates come down, that's going to improve that scenario for you and maybe make it a little bit easier to qualify. But with that, we set interest rates today, we're using 6%. Which means based off that loan amount of $294,566, that's going to give you a principal and interest payment, a mortgage payment of $1,766. Now, in addition to that, you're going to have property taxes. Now, depending on where you're located in the country, that number is going to vary. Areas like Texas, areas like New York have higher property tax values. Now, I'm going to use the nationwide average, which is 1.1%, which is roughly what it is here in California, but the nationwide average is 1.1%, which means your property taxes are going to be $275 per month. On top of that, you're going to have monthly mortgage insurance. That's one of the downsides of an FHA loan, is not only do you have the upfront mortgage insurance, you also have monthly mortgage insurance, which stays on the loan for the life of the loan. You can never get rid of the mortgage insurance unless you put at least 10% down when you do that FHA loan, which in that case, it doesn't even fall off until after year 11. And most people buying using an FHA loan aren't putting 10% down. They're putting the 3.5% down option, which means that mortgage insurance is going to be on the loan for the life of the loan. There's no way to avoid this. Every single borrower, regardless of their credit score, regardless of, how much money they're putting down, is going to have mortgage insurance, at least for the first 11 years. Now, you can refinance out of this loan and get rid of that mortgage insurance at any time you want, as long as you have enough equity in that property and you go into, say, a conventional loan or another type of loan. Because if you go back into an FHA loan, you're going to have mortgage insurance again. But the mortgage insurance is 0.55% when you're putting just 3.5% down. So in the case of the numbers that we're talking about here, that's $135 per month. In addition to that, you're going to have property insurance, which covers your property from fire, from theft, that sort of thing. Now, this is also one of those numbers that can vary considerably depending on where you're located in the country. Areas like Florida, areas like parts of California now, property insurance has gone up considerably. But I'm going to use the number of around $100 per month, which is $1,200 per year in homeowners insurance, which I think would cover a $300,000 home. So in this case, we're using $100. So if we added all those numbers together, that gives you a total monthly mortgage payment of $2,276. So in the case that you make $50,000 per year, remember, our max front end ratio is 47%, which means we could not exceed $1,958 on our housing expenses. Well, the housing expenses here are $2,276, which means we're not going to be able to qualify for a $300,000 home, putting just 3.5% down if interest rates are at 6%. Using an FHA loan, we're going to have to go to a lower price home, or interest rates are going to have to come down, or we're going to have to put more money down. So $300,000 is out of the question. So how much could you actually afford? Well, if you ran those same numbers on a $250,000 home, your 3.5% down payment would be $8,750. Now, once you add that upfront mortgage insurance premium back onto the loan, which in this case is $4,222, your base loan amount, $245,472. Well, the interest rate, again, is 6%. That gives you a mortgage payment of $1,472. On top of that, you're going to have your property taxes. Again, we're using 1.1% because that's the nationwide average. That's $229 per month. In this case, your mortgage insurance would be $113 per month. And in this case, we're keeping the property insurance at $100, which gives you a total monthly mortgage payment of $1,913. So in the case that you have zero debt and you make $50,000 per year, you're under that 47% threshold of $1,958 because the payment is $1,913. In fact, you can have up to $417 in monthly debt and likely still qualify for this loan, assuming you meet all the other qualifications of FHA. Again, don't take this and run with it. Make sure you're talking to a professional, going through the process, not using these numbers. Like I said, there's a referral link if you want to talk to a professional in the description below, people that I know, like, and trust that you should talk to versus listening to me and running with the numbers. So if you could qualify for $50,000, then you could qualify for $75,000 of income as well. But as you saw with a $250,000 purchase price, we're really close to that max front end ratio of 47%, which means probably not going to be able to qualify for much more than that if you make $50,000 of income. So now we're going to talk more about the $75,000 of income. How much could you go up to if you made $75,000? Well, we said our max front end ratio in this case is $2,938, whereas we can have a back end ratio of $3,563. Well, when we talked about the $300,000 home a moment ago, we said that total mortgage payment was $2,276. So in that case, you would qualify on the front end ratio and be able to have monthly debts of over $1,200 and still qualify for that loan. But let's say, what are your max qualifications at $75,000? Well, let's take a look at a $350,000 purchase price. So in the case of $350,000, you're putting 3.5% down, which gives you a base loan amount of $337,750. So once you add that upfront mortgage insurance premium, which in this case is $5,911, that means you have a base loan amount of $343,661. So we're going to keep the mortgage rate the same because it essentially would be the same regardless of the purchase price there. So at 6%, that would give you a mortgage payment of $2,060 per month. Well, we have the property taxes, which in this case are going to be $321 per month. So in this case, I took the property insurance up a little bit at $150 per month. Now, could it be more than that? Absolutely. Could it be less than that? Absolutely. But we're using $150 for these numbers, which gives you a total mortgage payment, once we add all of that up, of $2,689 per month. In the case of that $75,000 salary, we know the front end ratio cannot exceed $2,938. So in the case of a $350,000 purchase price, we actually meet that qualification because our mortgage payment is $2,639. In fact, we could have around $900 per month in monthly debts that show up on our credit report and still qualify for this loan, assuming we meet all the other qualifications, right? We could go as high as a 57%, but that doesn't mean we're going to get it because we talked about that earlier in the video. But in this case, if you were the perfect borrower, you could have a max debt to income ratio of less than 47% on the front and that max of 57% on the back, which means you could qualify for this $350,000 home. But could you qualify for $400,000? Well, that's exactly what we're going to talk about right now. So at $400,000, putting 3.5% down, that's $14,000, which means we're financing $386,000 before we add that upfront mortgage insurance premium back in, which in this case is $6,755, which means our base loan amount is $392,755. At a 6% interest rate, that gives us a mortgage payment of $2,355. Our property taxes are going to be $367 per month. Our mortgage insurance is going to be $180 per month. I also kept the homeowner's insurance at $150 in this case, which gives us a total monthly mortgage payment of $3,051. Now, remember, our max front-end ratio of 47% is $2,938, which means on a $400,000 home, unless interest rates move down a little bit and or we put a little bit more money down, we're likely not going to qualify for this loan because our front-end ratio is a little bit too high. Now, in the case that you can make that front-end ratio work, you can still have some monthly debt, in this case of around $500, and still be within that 57% max debt to income ratio. So the reality is you're probably going to be somewhere around that $400,000 mark at $75,000 income. Now, as interest rates come down, which they're going to, you're likely going to be able to qualify for a little bit more home. Now, if you're one of those borrowers that has a lot of debt or super low credit scores, what I would do is I'd be focusing on trying to get my credit up, right? The higher your credit score, the better loan terms you're going to get, regardless of what type of loan program you do. Interest rate matters more than down payment, right? It's going to affect your monthly payment more than putting a little bit more money down. Now, to each his own, but I would work on my credit. Also, if I had a lot of debts, I'd work on trying to pay off those debts, because by paying off those debts, you're in theory going to be able to qualify for more home. So if you're in the process of determining whether or not you should buy, when you should buy, that's what I'd be working on in the process while the right property presents itself. In addition to that, you need to get pre-approved sooner than later. You cannot do it soon enough, because by doing it earlier, you know exactly where you stand. You know exactly what you need to work on, whether or not you could actually qualify based off your employment situation, right? Some people don't have jobs, don't have credit, want to buy a home and figure, hey, I'll just do it in 6 months when I have this. Well, no, maybe not, right? Let a lender look at your situation and say, hey, you need at least this time period on a job, or you need this credit score, you need to work on this, right? By doing it earlier, you'll put yourself in a better position. Now, if you're new to the home buying process, not sure where to start, I actually created a first-time homebuyer course where I go over a lot of this in more detail, on top of writing offers, how to choose an agent, how to negotiate repairs, how to just go through the entire process of buying a home. Not only is it super comprehensive, it's less than $100, which when it comes to the largest purchase that you're likely ever going to make, it's a very nominal fee. So if you're interested, you want to become an expert, do me a favor and check that link in the description below. Now, earlier, as I said in this video, interest rates are going to change, which means the numbers in these calculations are going to change. Now, I'll continue to update these videos, but 2 years ago, I did a video like this and I was using 2.25% for the qualifications, right? Because interest rates were so low. And then last year, I did a similar video and interest rates were somewhere in the mid 5% range. Interest rates are a little bit higher now, 6%, which means in theory, you're going to qualify for less home, but as rates come down, it's going to improve. But with that, don't use what I did here and just run with it. Talk to a professional, go through the process. But if you're somebody thinking FHA is the right loan for you, you want the additional qualifications, because a lot of it I didn't talk about in this video. I just kind of took a bird's eye view of what it is. If you want the details on everything that you need to have in order to qualify for an FHA loan, do me a favor and check out this video here.